Will there be a deal with China regulators this year? And what will the deal look like?
Yeah, the CSRC, which is China's financial regulator, very much similar to our SEC, the last 2 weekends has put out statements about resolving, actually allowing the PCAOB to do the audit reviews of U.S.-listed Chinese companies. That, in theory, would resolve the Holding Foreign Companies Accountable Act, which could see the companies delisted in 2024. So we don't have a definitive deal, Bob, but we certainly have the verbiage, the language, that it could be in the works.
Now, how much will that improve the overall environment? Will that go a long way towards dealing with a portion of the investors' reluctance to get involved with China at this point?
Oh, I think 100%. If you say to investors that these companies might be delisted, where you have no recourse, you have a zero, that people are going to take a very conservative path, and so I think it's certainly weighed on the space in a very significant manner over the course of the last year.
Now, there's a crowd, folks, that has been saying that China is becoming uninvestable because the political and the regulatory risk is now much higher than was perceived before. And yet, when you look at this, I see value players out there who don't seem to be very concerned about this. For example, I see Charlie Munger buying Alibaba. So some of this gets caught up in issues that are now really about investing or regulatory risk. They're not about that. It's really about investing as a political stance, right? I mean, China is what, 18% of global GDP right now. $400 billion in U.S. companies are investing in, get revenues from China. It seems like, how do you thread this needle? How do you decide China is uninvestable because of true regulatory and political risks that I as an investor have versus we're Americans, we shouldn't be investing in China because they don't support the world. And yet Charlie Munger, I just mentioned, folks, just turned around and started buying Alibaba.
Well, and the U.S. investors are heavily invested in the U.S. multinationals that are doing a huge amount of business in China. So you're already in China. And I think more important is just, in general, over the last decade, the broad emerging market index, broad China, really 50% of the sector exposure 10 years ago was in financials, energy, materials. And so some of the underperformance we've seen by emerging markets as China is simply the sector exposure, the value orientation, and that's led to this vast underperformance. And I think these U.S.-listed Chinese ADRs that we hold in KWeb really are the growth engine within the EM.
So, Tom, thread this needle for us. I see this split so clear in the investment community. There's people who think, there's three groups. People who think China might be uninvestable for legitimate political regulatory risk issues. There's a second group, the value guys, who don't don't care at all about this. If China trades for 14 times forward earnings or below, they buy. Charlie Munger buying Alibaba. There's a value call. The third group is the political people that say, guys, we should not be investing in China because they don't support any kind of values that we have. So there's kind of three different groups that are involved here. How do you thread this needle?
So a couple things. First of all, this situation didn't happen overnight. This has been signaled for a while.
Oh, yeah.
Right? And however, the market reacted as though it was brand new news, right? Number one. Number two, talk a little bit about what you did in advance of this news, because already you've done a good job of repositioning your holdings from U.S.-listed exchanges to Hong Kong exchanges where you still own the same underlying, correct?
Yeah, Tom. I mean, we're fiduciaries. We're stewards of our investors' capital. We've taken this law, HFCAA, very seriously. So we've moved KWeb. A year ago, it was about 25% in Hong Kong, 75% U.S. ADRs. Today, it's the opposite. So we've moved our Alibaba, Baidu, JD, NetEase, Bilibili completely out of the U.S. share class. It's a tax-free conversion. It's going to be done overnight. And we feel like just to make sure that in case the two sides do or don't come to solving, which we think is a very solvable issue, we've protected our shareholders, and we're continuing to monitor this on a daily basis.
So if it works out, great. You can continue to list in the U.S. If it doesn't work out, you're fine with Hong Kong. And back to Bob's point here, the underlying value in the meantime, these stocks have dropped dramatically in price. The valuations have been so much better, and they are, in fact, the same company. the China economy is stronger as it's ever been.
Yeah, we've had, really indiscriminate sellers for the political reasons Bob pointed out, for the holding foreign companies accountable. And that's led to this huge dispersion between the fundamentals and the price action. And it's not just Charlie Munger going in and buying. Alibaba just upped their buyback program from $15 billion to $25 billion. We have companies like Tencent, the last 9 trading days, been buying almost 1 million shares a day. So the companies themselves see a lot of value in the shares, and we definitely agree with that assessment.
Yeah, Tom, you got to admit, this, between Russia and China, it's sort of rocked the global investing world. Look, 4 years ago, you and I were all talking about, okay, we have to have asset allocation based on share of global market capitalization. China is, what, 18% of global GDP? And we should have asset allocations based on that. So you have a certain amount in, global funds or emerging markets, and it's based on market capitalization. And now, in the last year, we have had this whole debate about maybe we shouldn't be strictly looking at things just on market capitalization. Maybe we have to understand risk on a clearer way, and we have to rate political, regulatory risk on a much higher scale, which might create underweights, or in some cases no weights at all. My point is the conversation's changed a little bit over the last year. I'm trying to figure out what's the right way to explain that to people and present it.
So Brendan's did a good job of explaining what's happened in China as far as geopolitical risk and economic things that have happened over periods of time. And it seems kind of like every year something goes on which pulls it back. Again, Russia aside, I think it's apples and oranges. Russia's market cap is the size of Texas, right? So, however, we can't discount China. It's going to be something that we're going to continue to deal with our lifetimes into the future. But boy, how many times you get an opportunity to buy such good companies at discounted prices? I think this is just something to talk about.
Yeah, I noted, you and I were talking earlier, what astonished me about Europe with KWeb last year was the sudden onrush of assets into your fund. So the fund was cratering because people were selling it like crazy. Then all of a sudden, it just turned around. You went from, 50 million shares. How many? You quadrupled your shares outstanding. Basically, a huge number came in to buy the fund, created new shares. Can you explain how that happened? Was that people who wanted to short your fund who were creating new shares, or were there new investors? How did you suddenly, your assets went through the roof?
Yeah, it's mainly new investors. I think a lot of financial advisors, a lot of RIAs, financial professionals, they either aren't allowed to hold a Hong Kong share class or they don't want to. And so they're almost hiring KWeb to make that conversion for them, as well as to keep monitoring this situation where it's obviously very fluid. And we've tried to over-communicate with our investors about how seriously we've taken this law and the things we've done to protect our investors.